Now, September 2021 question number 2B, that is FM. Jahazi Limited. September 21 2B. Jahazi, right? Right. So Jahazi Limited is considering investing in the purchase of a machine for its manufacturing process at a cost of 5 million. It is not considering replacing. So it's a new project altogether. We are not replacing an existing one, right? Hi. Okay. Installation cost of the machine is expected to be 500,000. The machine is expected to have the useful life of 5 years, at the end of which salvage value is estimated at 800,000. That's the scrap value. This investment shall lead to increase in sales. In order to support the increased sales, the firm requires an extra investment in working capital at the start of the machine's useful life. Working capital, if you can remember, tulisema is the current assets minus current liabilities. Na ndio wakatuambia inventory balances will increase by 1.2 million, debtors will increase by 1.5, and creditors will increase by 1.7 million. Current assets minus current liabilities. The additional investment in working capital will be recovered at the end of the machine life. It's that bit we know. Hata wasipotuambia tunafaa to appreciate, once you invest in it as initial outlay, you must release it as a terminal cash flow, the working capital. Quantity of the product to be manufactured and sold in each year, given quantity. Unit selling price and unit variable cost, corner 45, 15, they're expected to remain constant each year. Fixed operating cost excluding depreciation are 100,000 per annum. The machine will require an overhaul at the end of the second year at a cost of 40,000, and that overhaul will be amortized separately on a straight line basis over the remaining useful life of the asset. Depreciation on a reducing balance basis at 32% per annum. Cost of capital is 13%, tax is 30%, using NPV. No my quality. Umanza I hope. Initial outlay cost of the new machine. Installation cost. So initial outlay. We have the cost. Cost of the machine. Is it 5,000? 5,000. We add what? Installation cost. Ambayo wametuambia to install it how much? So that total cost becomes what? So that means you've not gotten zero. Pick up or see zero. We are not replacing the old machines. So we just add the working capital. We add our working capital, where we have increase in stock. Inventory will increase by how much? 1,200, right? We add increase in debtors. Receivables, debtors will increase by how much? 1,500. Then we less increase in the payables. Some of the creditors ambazo wamesema ni ngapi? And for information, kama zita reduce, we simply do the opposite. Next time you'll be given a question like this, and then we're told debtors will reduce by 1,000. When debtors will reduce, just subtract. When creditors reduce, you just do the opposite. Now you'll do what? You'll add. So increase in current assets minus increase in current liabilities. When they do the opposite, you change the signs. There's a question of that nature, like we need to know how to adjust, how to deal with it in case we meet it. Hi. So what is our working capital? Okay. So the initial outlay becomes 6,500. Now, ile kazi iko hapa ni kupata DTS because of the reducing balance. So let me have a working for the DTS. For the depreciation tax shield. Cash flows are coming in for 5 years, right? So I can have the year. I can have the year. I can have year 1, year 2, year 3, year 4, and year 5. The figures in thousands of shillings. In thousands of shillings. Reducing balance. So we have the cost, which will be reduced by the depreciation. What is the depreciation rate? 30 ngapi? 32%. Then we have the net book value. Remember, reducing balance, we depreciate the net book value. Sindio? Mambo ndo kalikwama. Na sisi mnajua mambo ya depreciation ya reducing balance. Amazon be exemptiwa. Anyway, that's why we are here. As we start the first year, what is the cost of the machine? The cost of the machine as we start our first year, 5,000 or 5,500. Then we pay a multiple choice. One of the two. 55 or 5. I'm a 65. 65 65 women value. It can only be 55. The purchase price plus the incidental costs. Theater was straight line, you have got to depreciate. Yeah. So as we start the first year, the cost is 5,500. Depreciate at 32%. You get 1760. 1760 net book value kwa ngapi? The difference 3740. 3740 ianze year 2. Depreciate at 32%. Giving us 1197. The net book value 2543, right? Inanianzia mwaka wangapi? Mwaka wa 3. Times 0.32. How much? 840. 814. To depreciate, tuna depreciate na 814 tubaki na ngapi? $17.29. So you have 1729 at 32%. $553. Baki na ngapi? 1176. So you have 1176. Now ikifika mwaka wa mwisho kindly, kwa hii swali coincidentally ilikuwa inakuja sawa. What is the scrap value of this machine after the 5 years? Is it 800,000? 800,000 still. Now, what is advisable is this: when you're using reducing balance in the last year of its usage, you now ask yourself, ikianza mwaka niko na 1176, nataka nifunge mwaka na ngapi? 800. Itaidepreciate na ngapi? So in the last year you depreciate by the balancing figure, which would be 376. Kiswahili ilitengenezwa vizuri kwa watu wa kuumia. When you do 32% of 1170, you get 376. Coincidentally, you get that one because they tested the depreciation rate. Maswali zingine utapata ukifanya the 32%, the final value after 5 years will not be the scrap value of the machine. Itakunyorosha. So in the last year, you're using reducing balance kindly. Hapa ya mwisho, don't depreciate by the rate. Depreciate by the balancing figure. So it very much allowable. So can we have the DTS? 30% of the depreciation. 30% of 1760. Tax on depreciation. Tax on depreciation. What is the depreciation for year 1? 1760 times 30%. Sorry? 528. Depreciation of year 2 is 1197, right? Times 30%. Sorry? 359. Thank you. Year 3, 30% of 814. 244. Great. 30% of 553. 166. Finally, 11.3. That's kazi imekwisha. So twende kwa annual net cash flows. Annual net cash flows. So miaka ni 5, si ndio? So we have the year 1, year 2, year 3, year 4, and year 5. The figures in thousands of shillings. The figures in thousands of shillings. Amortization tax shield inaweza fanyia huko. Kama hapa kuna space inaweza imalizia hapa. Kanona space mjaiacha ni sawa. Now, tumepewa quantity. We have the selling price per unit and the variable cost per unit. So can I go straight away to contribution? Price minus variable cost. Ndio. The price per unit na variable cost inabaki constant. So meaning I can do a shortcut. Badala ya sales less variable cost nipate contribution, I can come straight away and talk about what? Contribution. Which is the price. Price ni ngapi? 45. Variable cost ni ngapi? 15. Then I multiply by what? The quantity. Price per unit lot number 1, 45 shillings. Here. I think that. And the variable cost per unit is how much? So the contribution margin is Contribution margin. Any what was statistics? Sinakwanga P minus B. Najua neighbor nataka kusema 30 lakini anajishuku ni 30. Contribution per unit, ndio. 45 minus 15, that is 30, right? In year 1, how many units? 20,000. So 30 times 20, 600. So in thousands of shillings, that is 600. In year 2, 30 times 25,
750.
750. Year 3, 30 times 30, these are 900. In year 4, 30 times 35,
1050.
10, 1050.
1050.
30 times 40, 1200. 1200. So share deal in a sales minus variable cost, we have contribution. We less what? We less fixed cost. Now fixed cost the coconut number 2. Fixed operating cost 100 per annum. So year 1 100, year 2 100, year 3 100, year 4 100, and year 5 we also have 100. Now that one gives us what? Earnings before depreciation and tax. Hapa ni 500, 650, 800, 950, and 1100. What do we less? We less tax at the rate of 30%. This is 150. 30% of 650.
195.
185.
195.
95. Thank you. 30% of 950.
285.
285. Then we add what? The DTS. Shaipafanya kwa working. Year 1 icing 528. Year 2 is 350 ngapi? 359. Year 3 ni 244. Year 4 166. And year 5 113. Now ukimaliza hiyo story kulikuwa na ile overhaul. Hiyo concept ya overhaul ni sawa na kusema tunanunua asset nyingine. When you do an overhaul, it involves buying some parts, replacing some parts of that asset. It's like you're doing another investment there. Na hiyo overhaul hata examiner amekuwa fair akatuambia it will be amortized separately. Amortized, depreciated, capital allowance charge, one thing and the same. It will be amortized separately on straight line basis over the remaining useful life of the asset. When are we carrying out an overhaul? In the year 2. So it will be depreciated from which year? From year 3. So for how many years? I was saying year 3, 4, and 5. So miaka 3, sindio? So therefore, hapa pia tunataka ku add amortization tax sheet. Vile tunafanya tu DTS. Hiyo ni straight line basis. The cost of amortization is how much? The cost of overhaul? I was saying 240. It will be fully amortized. So salvage value will be 0 over the remaining how many years? Are you looking at 3 years? I think that one we've agreed, right? Yes. Year 3, 4, and 5. So how much per annum? 24. Yes. So the letter 24 in year 3, 24 in year 5, 24 in year 4 and year 5. Then ukimaliza, sasa appreciate kuwa there is a cost. overall cost. An amount of how much in year 2? 240 cash is going out. So you have your net cash flows. Hizo tunaweza pata ndio. What about the terminal cash flows? Do you have the scrap value? Scrap value of the machine of how much? 800. Kama tungekuwa na hiyo overhaul, kama ingekuwa na salvage value tungeiongeza hapo. Because after 5 years pia ingekuwa na scrap value, but unfortunately si ni zero. Kwa hivyo hakuna. So here we simply come and add what? The working capital. So how much did you invest in as the working capital? We invested in how much? The eyes don't see the 1,000. The 1,000. Pick up, can you use the NPV now? Yeah. Don't forget that. Yeah. As long as you invest in working capital, hapa kwa initial outlay, remember to bring it here as a terminal cash flow. I think ikifika hapo, si expect mtu alemewe kwa NPV. NPV at 13%, lump sum ama annuity. Hayo ni swali ngumu. Table 1 ama table 2. Si lazima tujue mambo ya annuity na lump sum. Bora ujue ni table gani unatumia when. Do you use table 1 or table 2? We use table 1. Ndio. See my point. But table 1 ni lump sum. It's table 1. Kila mwaka umesimamia, ndio. But we appreciate kwa year 5 ziko mbili. We have year 5 here and we have another year 5 here. So I expect something of this nature. Kuna year 1, year 2, year 3, year 4, year 5, another year 5. The salvage value. When we remember, we invested in the machine, right? The project lasted for how long? For 5 years. What happens after 5 years? I scrap it off. So I terminate the project. So after 5 years, the project is no more. When the project will not be there after 5 years, what happens to its value? I scrap it off. So it's the cash flows associated with the ending of the project, terminating of the project. We are adding working capital because working capital is on a stock. Ndio, is on a stock. Hata hapo tumeona current assets minus current liabilities. Now, the working capital I invested in year 0 shall be maintained by this project over its life. For me to be able to produce and sell in year 1, lazima nikuwe na current assets na current liabilities. So the 1,000 that I have shall be there in year 1. I'll also need it in year 2, so I'll maintain the same level of working capital from year 1 to year 5. After 5 years, because I'll not be there in year 6, whatever I would have spent to buy the stock, it I sell. So that's why it's a plus. Sasa, kama ningekuwa year 6, still ningenunua hiyo stock. Ili niweze cooperate in year 6. But because I'll not be there, hiyo amount spend kununua, naenda kuisell sasa. Sasa, nipata ngapi? Hapo jimakia, ndio. Ebu check question 4B. Check question 4B of May 2021. Question 4B of May 2021. Just ikifika mahali uko sure unasema nitaangalia exam. Sasa ukifika nafasi yako uko sure. Hiyo unasema nitamalizia exam. Wacha nifanye kitu kingine. Twende May 2021, question 4B. Ama utamalizia ukirevise, ndio. Yache mchezo. May 2021 4B. Let's go there together. Even as a bigger. Let's take it. Alpha Limited, there. Now Alpha Limited. With A, but A, I gave you the notes. Rights issue cover notes for A. Rights issue cover notes. Hata ni notes ya kwanza topic 1. Topic 1, 2, 3. Kama nitafuta page number. Hii inamaanisha mtafungua hizo notes. Haya, fungueni hizo notes. Fungueni hizo notes. Niangalie. You are asking for a neighbor's bill. Please. So that we spend more time with yourself. Hatukiandika kwa notes lakini kwa zile notes tulipeana. For financial institutions and markets towards the end. Sawa. So Alpha Limited intends to introduce that because rights issue paper on hesabu, we can get some little time to find. So probably kufanya hesabu, highlight shows wali hapa mahali mbe mwalimu kuna swali ulilenga kufanya. Tuambie leo. Anyway, Alpha intends to introduce a new product branded Q into the market. This will require an initial investment in machinery costing 4.8 million. So 4.8 million, the cost of the machinery, right? The machinery will be installed at a cost of 200,000 and is estimated to have a useful life of 4 years and a salvage value of 800,000. Capital allowance will be provided on the machinery on a reducing balance basis. By the way, finance, hakuna tofauti kati ya depreciation, capital allowance, amortization, it means one thing and the same. Zote tunatafutia the tax shield. Sasa usiambie examiner umesoma tax sana. Ati tax ni allowable, depreciation is disallowable. Mwalimu wangu alikuwa anasema hivyo. Huku hatujui zote tax shield. Sasa whether waite capital allowance ama waite depreciation ama waite amortization. Sasa great. So if you are reducing balance basis, annual profits from the sale of product Q will amount to 19,000 before deducting depreciation on machinery. Wametuanzishia hapa. EBDT, ndio, before depreciation. An investment in working capital amounting to 340,000 will be required on commencement of the project. That is investment in working capital. Hapa wajatuambia it will be recovered. Let us not always wait to be told. As long as umeiweka hapa, lazima uilete as a terminal cash flow. The firm pays tax at 30%. Cost of capital is 15% per annum. The annual depreciation rate. Kwa hii swali, walituambia depreciation rate 32%. Sasa hapa nataka calculate. So how do you calculate depreciation rate using reducing balance? Na hili nyorosha watu. Can you be among the few who did your work? Because mambo ya calculate depreciation hiyo hata finance. Finance tunatumianga tu ile rate tumepewa, bila hapa tulipewa. Sasa sijui ni subject gani, ni FR. Hata FR tunatoanga rate. By the way, depreciation reduces the value. In answering part one of this question, we are borrowing it from the concept of time value of money, compounding and discounting. To get the future value, we take the present value into 1 plus what? Raised to power n. But now we modify that formula a little bit. Depreciation will not increase the value. Depreciation will reduce the value. So for that reason, hapa tuweki plus, hapa tunaweka minus. R is our depreciation rate. The present value, what is the present value of that asset? What is the future value? After the 4 years, what will be the value of that machine? 800. So the future value is 800. What is the present value? $4,000. Ukiweka 4,800 kunanyoroshwa. Plus what? Incidental costs are capitalized. So that's part of the total cost of the machine. So the present value is how much? 5,000. For how long? Can you get R? Hivyo tu. Si ungefikiria example. Msidanganyane. So 800 equals to 5,000 into 1 minus R raised to power 4. Can we divide by 5,000? Divide by 5,000. This is 0 point. One six. 96. 0.16 equals to 1 minus R raised to power 4. Can we get the fourth root? Fourth root of 0.16. as long as it's coming from the calc. Zero point 73. Umefanya 4 times square root ama 4 root. 0.63. So equals to 1 minus r. So r equals to so 0.63 minus 1 equals to minus r. So this is minus 0.37. So r equals to 0.37. Or you can say 37%. You know our depreciation rate. So here's some 37%. Examiner alitufanyia ndio akapata hii 32% kwa hiyo swali tumefanya. Initial outlay. That's right. What's up? Why did they have to get difficult just after paying the exam? So the initial outlay. Na ukumbuke working capital, usisahau. So cost of the machine 4,800. We add what? We add installation cost of 200, and that gives us the 5,000. So that is the total cost of machine. We are not replacing, but we add what? We add the working capital. How much was the working capital? 340. So our initial outlay becomes 53. 53.40. Terminal cash flows. We have the scrap value. We're told how much? 800. Then you remember what? The working capital again. And the working capital was 300 and what? So we are having 1140. Then annual net operating cash flows. Can we start by getting the DTS? Because of the reducing balance. Miaka ni ngapi? Miaka minne. So let's start by getting the DTS. So we have for 4 years, so we have year 1, year 2, year 3, and year 4. The figures in thousands of shillings. Where we have the cost, it will be reduced by the depreciation at the rate of 37%. Then we have the NBV. Haya, tukianza mwaka wa kwanza, what is the cost? 5K. Depreciated by 37%. Gives us
1850.
NBV at 150. So that 150 starts year 2 times 0.37. 11 66. Funge mwaka na ngapi? $18 1884. 1984. So 1984 will start our year 3 times 0.37. 734. We cross there with how much? 1250. So we start with 1250. Kwa sababu depreciation tulicalculate. Tukifanya times 37% shall get it right. But I really want to discourage that. In the final year, depreciate by what? The difference. And the difference is how much? 450. But for the sake of this question, I'm very sure that 7% of 1250 will get 450 or something close to that. How much? 452. Rounding off errors hiyo imetupeleka mbali. Haya, sawa. So can we have our DTS? 30% of the depreciation. So 30% of 1850. 5. 555. So 555. 30% of 1166. 35. 350. 30% of 734. 220. Finally, 30% of 450. 35. 135. So now, annual net cash flows. We'll have year 1 mpaka year 5. Year 1, year 2, year 3, mpaka year 4, sorry. Cash flows in thousands of shillings. We have the pre-tax cash flows. Pre-tax cash flows. How much each year? Annuity or lump sum? Of how much? Is it 1920? Whether kama ni annuity, si basi ni summary, niseme year 1 to 4. Inaweza ingiana? Haiwezi by the way. Kwa sababu ya nini? Kwa sababu ya DTS. DTS ni tofauti. Yeah. So lazima udi express kama lump sum. Because the depreciation for each year is different. Sasa that's why sijasema 1 to 4. Nimeweka kila mwaka kivyake, so I'll have 1920 in each of the years. Because depreciation is not on straight line basis. Sasa we less what? We less tax at the rate of 30%. 30% of 1920. Niambie tu moja zingine najua. Sorry? 576. And these other ones I know. Then we add what? The DTS. 345 in year 1, 350 in year 2, 220 in year 3, 135 in year 4. Hii swali iko na ujanja mingi. Then you are required to use NPV. Now again with your permission, can we let it be at that point? Or this time round you want to finish? So you can finish later. So that we do another one. Think it pick up about the ndio. Kama kuna swali? Uliza. That which 800? Hapa the terminal cash flow. Ilikuwa itumike kwa miaka ngapi? Kwa miaka 4. The scrap value. The scrap value. So 800 is the value after the 4 years, the scrap value of that machine. So can we go to 2020? Question 4. Acha tu space, utajichocha. This kama kuna mtu kwa una map kwa mwambia yake nyumbani, map yako wewe unafanya hapo. Kama kunaye, ndio. Kama hakuna ufanye yako leo. So 2020 question 4A. Ni sitting moja tu kwa sababu tunasema Mei ama hapa November. Mejibu before neighbor ulize. Page 35, let's go there. Ulanda Engineering, we're there. Now, Ulanda Engineering Works Limited is contemplating the purchase of a new machine to replace the existing one. Now, here we have the replacement decision. Replacement decision, as we buy the new machine, we sell the old machine. Hi. So it's contemplating the purchase of a new machine, replace the existing one. The existing machine was purchased 2 years ago at an installed cost of 500,000. So you're planning replacing it, having used it for how long? For 2 years. Ndio. Tumeitumia kwa miaka miwili, tunafikiria kuleta nyingine. We replace. Replacement ni sawa na trade in. The machine was estimated to have an economic life of 5 years with nil salvage value. So originally, wakati tuliibuy, ilikuwa itumike kwa miaka mingapi? Miaka 5. Tushatumia miaka mingapi? Miaka miwili, tumebakisha ngapi? 3. So originally, based on our previous analysis, we are left with 3 years. But a critical analysis of its performance now shows that it is usable for the next 5 years with a resale value of 100,000. I like interpreting the question. When you internalize and interpret it, it becomes easy to apply. Tukibuy, ilikuwa itumika kwa miaka 5. Right? The salvage value ilikuwa ikuwe ngapi? 0. Tumetumia kwa miaka miwili, tumebakisha 3. Sindio? Now, instead of being used for the remaining 3 years, things are changing. We shall now use it for 5 years instead of 3. And the salvage value will no longer be 0. Now it will be what? 100,000. We shall see how to apply it. The current disposal value of existing machine is 200,000. As we buy the new machine, we sell the old machine at 200K, right? The new machine would cost 600,000 and require 50,000 in installation costs. Since the machine is not locally available, the company plans to import it and will pay import duty and freight charges of 150 and 100,000 respectively. Zote ni incidental. The new machine shall require an overhaul at the end of 3rd year, which is expected to cost 100,000. The overhaul cost is to be amortized on a straight line basis over the remaining useful life of the machine. Believe by now overhaul cost I buy t-shirt. We know how to deal with it. To support the increased business resulting from the purchase of the new machine, accounts receivable will increase by 250,000. Inventories and accounts payable shall increase by 200 and 300,000 respectively. Increase in current assets minus increase in current liabilities. It forms part of what? The working capital. The working capital. At the end of the 5 years, the new machine will be sold for 250,000. Scrap value of the new machine. The estimated profit before depreciation and taxes over the next 5 years period for both machines are given as follows. So you have year 1 mpaka year 5, existing machine and new machine. Replacement. Tulisema it is new machine minus old machine. The profits from the new machine minus the profits from the old machine. Kwanzia kwa initial outlay mpaka kwa terminal cash flows, it is new minus old. Sasa, initial outlay, ndio sababu tunaweka cost of new machine minus the disposal value of the old machine. Everything is new minus old. By bringing in the new machine, we are doing away with the old machine, right? So everything that was coming from the old machine, tutaziforgo. So as we gain from the new machine, we lose from the sale of the old machine because the machine is no longer available. So we are replacing it. Yeah. It's like a trade-in. Tax is 30%, straight line method of depreciation, cost of capital 13%. Capital gains are tax exempt. Wow. The incremental initial cash outlay for 4 marks. Are you about to get the 4 marks? Or I finish what I start? Ifanya kazi yangu. Kama unataka kujaribu. Eba hayuko sure. Kwa kula fanya kazi yako. Heavy measure. So the initial outlay. We have cost of new machine. The new machine will cost how much? 600,000. So that is 600. Then we add what? On an installation cost of how much? Of 50. We also have what? Price charges. That's gonna import duty. We'll pay import duty and freight charges. So freight charges they're 100. So that's import duty and happy. Yeah, 150. That
Wait.
gives 300. I have it 300. 200 plus 100 still. So that gives us total cost of new machine. I think 900. As we buy the new machine, we sell the old machine. So we less. Disposal value of what? Of old machine. Ambayo ni ngapi? I think 200. The current disposal value of existing machine is 200. Then we have what? Tax on gain, stroke loss on disposal. Now, in our case, because of note number 4, take a dash. Because wamesema nini? The capital gains are tax exempt. So there's no capital gain tax. Because of note number 4, take a dash. Sawa. But because tuko class na tunajifunza hizi vitu, situjifunze otherwise. What if note number 4 haingekuwa? Sawa. What if note number 4 haingekuwa? I'm doing this because we are in class, but in examination scenario, you don't need this working because examiner has made life easier. The tax exempt. So here, ningeangalia the disposal value. Disposal value of old machine, ambayo ni ngapi? Ambayo ni 200. Then I less what? The net book value of old machine. What is its net book value today? It is after how long? After 2 years, thank you. What was the cost 2 years ago? The cost 2 years ago was 500, right? So cost minus accumulated depreciation. So the cost was 500 minus 500 minus what? What was the salvage value? Silikuwa ikuwe 0. Tunaangalia kula kutoka ile time tulibuy 2 years ago at 500, ilikuwa depreciate kwa miaka ngapi? kwa miaka 5 with no salvage values. So this one gives us annual depreciation, but we've depreciated for how long? For 2 years. So cost minus accumulated depreciation. Giving us NBV of how much? 300. So hapa tungekuwa na tax on gain ama tax on loss? Tax on loss. So 30% off, is it negative 100? Lakini hapa wamesema they are what? They are exempt. Kwa hivyo tunaweka dash. Then we add what? We add our working capital. So working capital increase in inventory. Stock will increase by how much? I think 250. Debtors what increase and what reduce? Or inventory in 200. And debtors need? Debtors go to 50. Then we less increase in what? The payables for the creditors ambazo zita increase na ngapi? I think 300. So how much do we have? 150. So the annual net cash flows, miaka ni ngapi? Miaka ni 5, sio? So mwaka wa kwanza, wa pili, wa tatu, wa 4 na wa 5. So the figures are in thousands of shillings. Now, can we start with the earnings before depreciation and tax? And remember, I repeat, it is the replacement. Replacement, it is new machine minus old machine. The incremental cash flows. The incremental cash flows. Hata ukiangalia vile wametuliza kwa required number 1 is incremental initial outlay. The additional initial outlay. New machine minus old machine. Number 2, they're asking about the incremental net operating cash flows. Incremental, the additional. How much more are we getting by bringing in the new machine and replacing it with replacing the old machine with the new one? That's how. So the new minus old. New machine minus old. In year 1, what do we have? How much? 140. 140 in year 1, right? In year 2, I have 130. In year 3, 120. In year 4, how much? 95? 95. Year 5 now, 135. 135. Then we less. Do you remember tax? 30% of 140. How much? 52. 42. 30% of 130. 39. 30% of 120. 36. 30% of 95. Sorry? 28.5. Nayo ya mwisho 40.5. Then we add what? The DTS. And that's why replacement, new minus old. After DTS, the new machine minus old machine. So DTS, can we start with the new? The cost of the new machine is how much? 600, 900, 700. Are you all seeing 900 this time round? The cost plus the incidental cost. Ndio. Salvage value yake ni ngapi? The salvage value of the new machine, I think 250. Kwa miaka ngapi? Kwa miaka 5. How much is our annual depreciation? $130. So here inakuwa working hapo. Then you bring in the old. An old machine, we always depreciate what? The net book value. Ile value tumebaki nayo leo. Ndio wamesema originally ilikuwa itumike kwa miaka zingine 3. But now things are changing. It will be used for another 5 years and the scrap value will now be how much? 100K. You're in the old machine now, right? Originally, tulibuy 2 years ago, ilikuwa tumike kwa miaka 5, tushatumia miaka 2. Tumebakisha miaka 3, si ndio? But wamesema hapana, we are reviewing it. It will now be used for another 5 years instead of 3. And the salvage value will no longer be 0, it will now be 100. No, are you seeing that concept? That's why niliwaambia, I think kuna swali tulifanya nikasema always go with the net book value. Because that is the value today. In case of any change, it is that value that is now changing. So our NBV is how much? Siko hapa. So 300. Salvage itakuwa ngapi sasa? Miaka ngapi? Miaka 5. So 200 over 5. How much? 40. 40. So we have the DTS. 30% of 90. 27. Is it? kulikuwa na overhauls, ndio. Tuongeze pia nini? Amortization, tax shield. What was the cost of overhaul? Paragraph 2, the new machine shall require an overhaul at the end of third year, which is expected to cost 100,000. It will be amortized on straight line basis over the remaining life. If we carry out an overhaul in year 3, it will be amortized for how many years? The remaining 2 years, year 4 and 5 still. The cost is it 100? Salvage value itakuwa ngapi? For how many years? For 2 years. What do we have? How much? 15. So 15 in year 4 and 15 in year 5. Alafu tulete nini sasa? We have the overhaul cost of how much in year 3? 100. Cash is going out. So the terminal cash flows, we have the scrap value of the new machine. Which was how much? 200 and 250 still. Then we less scrap value of what? Of the old machine. Ambayo ni ngapi? Nil or 100? Kata potea. It's now 100. Metusaidia kwa depreciation. The overhaul has no scrap value, so you only need to bring in here what? The working capital. How much of the working capital do you invest in? 150. So just for the sake of clarity, for the sake of clarification, angalia required number 3. Just check required number 3 kindly. Wamekuambia tu, the examiner is giving you 4 marks and asking you, should the existing machine be replaced? Now, how do you answer that one? You use NPV, PBP, IRR, or what do you use? We always advise using NPV, unless otherwise stated. Sawa. Unakumbuka tufanya advantages of NPV. Advantages zake tulizitoa kwa qualities of the good investment appraisal technique. Meaning NPV is a good investment appraisal technique. So unless otherwise stated, we always advise using NPV. Sawa. Kama ako silent amekwambia tu advise, kindly use NPV. Kama nitakutumia nyingine atakwambia using IRR, using blah 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 profitability index, but we advise using NPV. That is okay.